ladies and gentlemen. Just as everyone gets seated and in and out of the room, I'll introduce myself. My name is Amir Adnani. I'm the founder and chairman of GoldMining Inc., ticker symbol GOLD on the TSX Venture. We are in the process right now to get our TSX up listing, so hopefully in the coming months we'll be listed on the Toronto Stock Exchange. GoldMining.com is our website address. Standard disclaimer statement. Let's take a quick overview of where we stand today. You know, I got to just put you in my shoes for a second, because just moments ago, before coming up here, I was speaking with one of the most influential investors in Vancouver in resources. His name is Nash Jiwa. I don't want to put him on the spot. He's sitting right up here. He's over at Haywood Securities. He's a mentor. He's a large shareholder of the company. And I said to him, I said, Nash, for me, the biggest regret is going to be looking back when gold breaks above $1,400 a gold and say, geez, I wish we had bought more gold assets. That our job right now as a company is to be busy acquiring assets for one simple reason. I mean, let me just ask in this room, because this is how convinced I am about what we're doing. Mineral Exploration, which is an advisory group that looks at exploration for the whole industry, just announced that in the gold industry, the average unit cost to discover a gold resource in the ground is $45 an ounce. $45 an ounce to discover a gold resource, and by the time it becomes a reserve, it's probably over $100 that has gone into defining that. So in that kind of world, would you not want to be buying resources in the ground without any exploration risk taken for less than $15, less than $10 an ounce in the ground? I mean, who doesn't think that's not a bad idea or a good business? And so the conviction that we have in executing this is reflected in the year we had in 2017. In 2017, we were the only junior company in the world that acquired 3 different resource stage projects. And that was just last year. And through these acquisitions, through our roll-up strategy, we now control 9.5 million ounces of global measured and indicated resources, 11.7 million ounces of inferred resources, and most importantly, we've done it all with 0 debt. That's the key, 0 debt on the balance sheet. We've underwritten every acquisition with our own shares, share-based acquisitions. Every acquisition has been accretive. Insiders own 25% of the company, and we're still sitting on over $15 million of cash at a time when the company's annual burn rate is $5 million, keeping things very tight. You look at the salary structure of our company, and our executive team is getting paid probably what people pay their investor relation offices. I mean, this is such a tightly run company, very much focused on equity ownership that we have in the company. Many of you know that we got lucky in 2013 with our Uranium Project. We have a joint venture with Areva. Many of you know that was not by design, and many of you hopefully know that as the 2 sponsors listed here, I'm the founder of 2 companies. I'm the CEO of Uranium Energy and the chairman of GoldMining, the 2 yellow metals. So we know a thing or two about uranium, and I think if you're a gold mining investor, you should be paying attention to what's going on in the recovery in the uranium market, because there's a fascinating recovery. Uranium has also been dead for 6 years and coming back. And our gold company not only controls this massive portfolio of gold resources in the ground, but we have a bona fide joint venture with a major in Areva in Western Athabasca Basin, where Fission and NextGen have done incredible work. And we've been busy this year. This year we hit the ground running. We announced our first acquisition right out of the gate, picking up more ground in Canada's Northwest Territories, next to our Yellowknife Gold Project. Geopolitically stable jurisdiction, Greenstone Belt, the project that the land package that we're building in Canada covers the old Discovery Mine. The Discovery Mine, look that up on Wikipedia, is one of the oldest, highest grade gold mines in the history of Canadian gold mining. And we now control 11,000 hectares all around that with previous drilling. We're working towards a resource report. And just last week, we announced our latest resource estimate of the Crucero project in Peru. 1 million ounces in the M&I category, 1 million ounces in the inferred category, just over 1 gram per ton at a 0.4 cutoff. These are excellent grades for pit-constrained resources in mining-friendly jurisdictions. And This is the graph that I kind of, in a way, live by. This is what I look at and say to myself, I want to put more deals on this graph. This basically shows you on your left-hand side our total acquisitions to date. $68 million of acquisitions. The bars on the right are all the different companies that we acquired. These companies were all publicly listed companies. You can go look at their market caps. Their combined market caps were over $800 million. So $800 million of combined market cap when gold was at $1,500 an ounce. And when gold has been generally at $1,200 an ounce, we've bought the same companies for $68 million in stock. I mean, by a show of hands, does anyone in this room not believe that gold is going to $1,500 at least in the next year or two? Anyone think that? I mean, if you thought that, you probably shouldn't be listening to this presentation. And this weekend alone, Barron's magazine, Barron's in the US, their commodities corner, has an article talking about we may see the new record in the gold price this year. Wall Street is becoming bullish on gold. Mainstream is becoming bullish on gold because of inflation, because of excessive valuations in the stock market, because of excessive valuations in Vancouver real estate, soccer players in Europe, or just about everything on earth. Should gold be at $1,200 in this kind of environment? I sure as hell don't think so. And that's why we're building the kind of leverage that we're creating here. The Crucero project in Peru, with this latest acquisition, again, I want to highlight the fact that by going out there, the profile of the acquisitions we make has to check a number of boxes. We want an existing resource. We want to be able to hang our hat on an existing resource report because that reduces our exploration risk. So if I can sit here and say to you, hey, I've got a great property, it's got great potential, I sound like any other mining company CEO or chairman. But I want to be able to say, hey, $50 million of work has gone into this project, drilling has identified resources, we're buying it for $5 million when the historic spent is 50, there's 2 million ounces of resources, and then I can say on top of that there's 10 or 15 different exploration upside targets. But you and I know we can hang our hat on a resource, a pit-constrained resource in a proven jurisdiction, and that's a classic case of an acquisition that GoldMining looks for. And we also look for consolidation opportunities. We look for fragmented situations, like in Colombia. By the way, in Colombia, in the last 100 years, they've discovered somewhere around 100 million ounces of gold resources. And when we looked at the kind of geologic potential of this area, we realized that the mid-Coca Belt in central Colombia is very much underexplored. Majors and mid-tiers are rushing into central Colombia. We've consolidated 2 land packages, Titiribi-La Mina. These used to be 2 separate public companies. Their combined market cap was $500 million. We bought both for less than $40 million in stock and have now consolidated a district in central Colombia. But again, a district where I can say to you, 376 holes have been drilled. We have 43-101 resources that point to over 10 million ounces of gold resources. High-grade epithermal zones have been intersected, and low-grade gold-copper porphyry exist on the project as well. So consolidating a land package in a very active region, but doing it as well, leveraging infrastructure, historic work, and also the resource reports. And same thing about what we're doing in Canada and the Northwest Territories with the Yellowknife project. I'm going to be winding it down here soon. But again, another example of where we're leveraging previous work done to the tune of $60 million. We acquired it for $6 million in stock. Area this project was developed with a feasibility study historically. We're adding more land to the project and the land package, and it's home to some of the highest grade gold mines in Canada historically. And our Rea Uranium Project, which is a joint venture with Areva that I already talked about. We have 134 million shares outstanding. If you add all of our gold resources, we're over 20 million ounces of gold in the ground. At our current market cap, we're trading just under $10 an ounce in the ground. We're debt-free. We have enough cash to give us optionality for the next 3 years. We're covered by 3 analysts that have target prices north of $4 a share for a company that's trading at about $1.30 a share. Marin Katusa and his KCR fund have been significant shareholders, or largest shareholders since day one. Sprott Asset Management, myself and my family, and our entire team of insiders that own 25% of the company. And really, I think just to bring it kind of to an end, because I'm out of time, I just want to really emphasize, and this is what I'm going to talk about more during my workshop at 1:40 p.m. If you attend that workshop at 1:40 p.m., I want to talk about contrarian investing. I'm standing here in front of you with two companies, Uranium Energy and GoldMining, that in order to be active in these two commodities, the two yellow metals, you truly have to be a contrarian investor. Ladies and gentlemen, hedge funds in New York cannot afford to be contrarian investors because the market is moving so much, they're forced to chase return. Being a contrarian literally means you have to chase things that are out of favor. By definition, you're not chasing. That's where I think value creation is long-term. That's why I have a significant amount of my own capital tied in with GoldMining. That's why we're buying projects, and that's why I want to be busy now, not when gold goes over 1,500, because when gold goes over 1,500, we have a large, diversified portfolio, one of the biggest in the Americas for pre-production companies, that we can joint venture, we can sell. And in a world where it costs $45 an ounce to find a new gold resource in the ground, I believe will also be a very attractive M&A target for larger companies who are looking for growth and growth potential in their pipelines at good, safe jurisdictions. And between Canada, US, Brazil, Colombia, and Peru, we look like a mid-tier company. We have the portfolio of a big company, but still very much small and humble that you're here, humble that many of you who are shareholders that I see are in this room listening to me on Sunday. Thank you very much. Come to the talk at 1:40 p.m. We'll drill deeper, and thank you again.